Wall Street just hit record highs, and the reason has nothing to do with earnings season, interest rates, or AI. According to reports from Reuters on May 29, 2026, both the S&P 500 and the Nasdaq closed at all-time highs after news broke that the United States and Iran had reached a draft agreement to extend their ceasefire by 60 days. At the same time, industrial metals posted their best monthly gains since January. But here is the tension: on the very same day, a key inflation gauge hit its highest level in 3 years, and American savings rate dropped to its lowest point since 2022. So who exactly is this rally for, and what happens when the 60-day clock runs out? In this video we are unpacking the full picture behind today's market surge, the US-Iran ceasefire deal and what 60 days actually buys, why industrial metals are surging to monthly highs, the inflation reading Wall Street is choosing to ignore, what a falling savings rate tells us about real household stress, and the one number that will define where markets go next. Stay with us. The market-moving news arrived in the early hours of May 29, 2026. According to posts from Reuters, the S&P 500 and the Nasdaq both closed at record highs after news reports indicated that the United States and Iran had reached a draft agreement to extend their existing ceasefire by 60 days. It is important to note that the Reuters post described this as based on news reports, meaning the deal had not yet been formally confirmed at the time of publication. Almost simultaneously, posts from Business reported that industrial metals were headed for their best monthly gain since January, directly linking the move to the same tentative ceasefire extension. This is significant context. The ongoing conflict in the Middle East had previously disrupted energy and commodity flows, with the International Energy Agency separately reporting that Iran's oil exports via the Strait of Hormuz had been curtailed by a U.S. blockade. A 60-day extension removes, at least temporarily, a major tail risk that had been weighing on global supply chains and commodity pricing. However, the same trading session delivered two sharply contrasting data points for the broader economy. Posts from Fortune magazine reported that a key inflation gauge accelerated in April to the highest level in 3 years, with spiking gas prices and higher food costs squeezing American household finances. And separately, posts from The Hill reported that American savings rate had fallen to its lowest level since 2022, a sign that many households are drawing down their reserves to cover rising daily costs. The juxtaposition is striking: record stock market highs sitting alongside 3-year inflation highs and multi-year savings lows. This is a market celebrating geopolitical relief while the underlying consumer economy shows signs of material stress. Let us put these numbers in context, because the surface narrative "markets up, everything is fine" deserves careful scrutiny. The first question analysts are asking is, how durable is a ceasefire-driven market rally? The short answer is, historically, not very. Geopolitical relief rallies tend to be sharp but short-lived. A 60-day extension means the core dispute, U.S. sanctions pressure on Iran, the nuclear question, and regional proxy conflicts, remains entirely unresolved. When the clock expires, markets will face the same binary they faced before this news: permanent deal or resumed escalation. This may suggest the rally is pricing in optimism about a longer-term resolution, but that optimism is not yet supported by confirmed treaty terms. A second pressing question is, what does the divergence between market performance and consumer conditions actually mean? On that front, the data is uncomfortable. Record Nasdaq highs reflect the performance of large-cap technology and growth companies. They are not a proxy for the broader economy. Meanwhile, inflation at a 3-year high combined with savings rates at a 4-year low is a pattern that signals household financial stress, consumers spending down savings to maintain living standards in the face of higher prices. This divergence between equity, wealth, and wage earner conditions is a pattern that has historically preceded periods of political and economic instability. The industrial metals surge is the most concrete positive signal in this cluster. Copper, aluminum, and related commodities are highly sensitive to expectations for global manufacturing and construction activity. A ceasefire reduces shipping insurance costs on Persian Gulf routes, reopens supply corridors, and signals a potential return of regional industrial demand. Some analysts believe this metals move may be the most reliable leading indicator in today's data, more reliable than the equity surge, which carries speculative premium. How durable is a ceasefire-driven market rally? Historically, geopolitical relief rallies tend to be sharp but short-lived. A 60-day extension leaves the core dispute unresolved. When the clock expires, markets face the same binary as before. This may suggest the rally is pricing in longer-term optimism not yet supported by confirmed treaty terms. What does the gap between record markets and deteriorating consumer conditions actually mean? Record Nasdaq highs reflect large-cap performance, not the broader economy. Inflation at a 3-year high combined with savings at a 4-year low signals household financial stress. This divergence has historically preceded periods of political and economic instability, a pattern worth monitoring closely. In the United States, the rally lands differently depending on where you sit in the economy. For the roughly 60% of Americans who own equities primarily through 401k plans and index funds, today's record highs represent a direct balance sheet gain. For the remaining 40% with little or no equity exposure, the more relevant data points are the 3-year inflation high and the 4-year savings rate low. According to posts from Fortune magazine, spiking gas prices and higher food costs are the primary squeeze expenses that affect every household regardless of stock market participation. In the Middle East, and specifically for Iran, a 60-day ceasefire extension is a temporary reprieve that does not resolve the underlying sanctions architecture or the U.S. blockade on Iranian oil exports through the Strait of Hormuz. The IEA has reported that Iran's exports via the strait have been curtailed, meaning oil revenues that fund Iranian public services remain under severe pressure. The extension may signal back-channel progress, but the underlying geopolitical equation is unchanged. In Europe and Asian manufacturing economies, the industrial metals surge is the most direct transmission mechanism. Lower shipping risk in the Persian Gulf corridor reduces freight costs and insurance premiums for manufacturers dependent on Gulf region raw material supply. For economies like Germany, Japan, and South Korea, all heavily reliant on industrial output, a ceasefire extension is an unambiguously positive near-term development, the one that remains contingent on the 60-day clock. The bull case deserves to be heard clearly and fairly. 60 days of ceasefire in one of the world's most volatile flashpoints is 60 days of reduced risk of an energy price shock that could have sent oil prices to historic highs, triggered global recession fears, and disrupted food supply chains dependent on Gulf shipping. The market is not being irrational, it is pricing in a genuine, measurable reduction in tail risk that was concrete and immediate. Industrial metals independently confirming the equity move suggests this is not purely speculative sentiment driven by algorithmic momentum. And if 60 days does eventually become a permanent resolution, the economic upside, lower energy costs, restored shipping routes, reduced defense spending, renewed regional investment could be substantial and sustained. The skeptic's case, meanwhile, rests entirely on a 60-day clock that has not yet expired. Here is the number to write down: day 61. If the ceasefire hardens into a permanent agreement, today's rally may look like the starting pistol for a major sustained recovery. If it collapses, every gain made today could reverse in a single session. Mark your calendar. Drop your prediction in the comments right now. Does this ceasefire become a permanent deal, or does the clock run out? Subscribe so we can cover every development as day 61 approaches.